but how many days, if you've calculated that, before it becomes a really serious problem?
Yeah, I think it's just a few days.
Okay, we have two very important things to discuss here in this video, but I just first want to share with you the huge discrepancy that we are seeing on Wall Street right now. On one hand, you have this clip on CNBC that says, I don't see how we get to 2% inflation without a recession. This clip that says, economy will see ripple effects of strike within hours. But then this guy that says the Fed is gliding the landing just right. Or that the broadening out theme will last for years, in which I do agree with that, but the problem is not whether markets go higher or not on an individual stock basis, or whether there's a broader rally or not. Most people benchmark the markets to the S&P, to perhaps the NASDAQ. And what you're seeing right now is, yes, a massive disparity between cyclicals and small caps that have underperformed. But why have they underperformed? They've underperformed because there has been this looming recession risk. The headline S&P has ignored that recession risk for a very long time. Now, where we are right now in the business cycle appears to be late cycle. And for some people that think, I want to see some kind of recession or something along those lines, I do not. Death, divorce, default runs rampant during recessions. That's the last thing I want for the American public or the world populace. The problem is you need to be prepared for a recession. The best I can do is prepare as many people as possible in a delusional market. I say it all the time. This market is delulu. It stands for delusional, okay? Even with this latest port strike that is expected to start within the next 4 hours, almost a guarantee is going to start within the next 4 hours, is going to have a massive impact on an already weak consumer, already weak economy. The Fed made it clear today, if you want to see how the economy is doing, don't look at GDP. That's basically what Fed Powell said today. He said, don't look at GDP. GDP is kind of a lie right now. He said, look at the labor market. And when Jerome Powell was asked about whether a 50 basis point cut, the recent 50 basis point cut, increased his odds of a soft landing in his mind, right? Did he become more confident on this? He paused for a while and didn't sound that certain. We have problems. Yes, we have the problem of, does the economy head into a recession or not? That is obviously a problem. But if you're an equity investor, the bigger problem is not a recession or no recession. You need to look at this market in terms of a percent. Okay, if recession is 100% and that's bad, then where would you assign the probability with a reasonable mind? Let's assume we all have reasonable minds here. Where do you think the odds of a recession actually are? I mean, Somm rule, inverted yield curve, unemployment rates starting to rise, right? Manufacturing is hemorrhaging jobs. There's 300% times more housing inventory today and 60% less home buyers. What happens when prices of homes start to fall? What about the service sector that has really started to weaken in recent months? The leisure, travel, hospitality sector that is really not in a super strong place like it has been over the past couple of years. I mean, all of these things should raise the recession odds somewhat, right? Collectively putting all of them together and now add the port strike on there. What do you think recession odds should be? I'll let you chime in down below. But I will tell you, the odds of a recession assigned by the S&P and by Wall Street right now is 0%. Really, whether or not we get a recession is really just an afterthought. It is going from 0% chance of a recession up to something more reasonable, like let's say 50% chance of a recession as this port strike occurs, as maybe economic data in the coming weeks and months starts to come in bad, the odds of a recession will not stay at 0%. They will rise to maybe 50%, maybe more than that, right? Like you seen in 2022, the odds of a recession at one point in October when markets bottomed was 100%. Even though we didn't go into a recession, S&P was down 27%. Okay, well, we've extended that rally a lot more than where we were even extended, you know, in 2021, early 2022. Okay. What would you think would be a logical outcome to that? Starting to price in recession. It would be material downside. So no, I do not wish a recession. That's the last thing I wish. That's not good for business. That's not good for anyone. Okay. Now, if you have money and you're able to capitalize on that, recessions can be good for certain people, right? It can be good for you financially. But then again, are you going to lose your job? Like that's, I think, a bigger, more pressing issue at that point. The only thing I'm trying to prepare you guys for is the massive convergence that we are going to see in the coming months. Right now, there's a massive divergence where markets are going up. I guess they're both going in the same direction. Markets are going up. Recession risks are going up. But imagine them like they're getting further and further apart from each other. And now it's at really laughable levels, right? Markets are way the hell up here. Recession odds are way higher now than they were a couple of months ago. And eventually that mismatch, if you want to call it that, will correct itself. And you will get 20+% downside. I don't know exactly what day that'll start. It'll start with an economic data point. I can tell you that with certainty. But it will start at some point. Now, it is being reported tonight that East Coast Port Strike ILA Union rejects a wage hike offer near 50% as shutdown at midnight nears. For the week ended last Friday, nearly $14 billion in trade arrived at these ports, including New York and New Jersey, Baltimore, Norfolk, Virginia, Savannah, Georgia, Miami, New Orleans, and Houston, with $2.7 billion in trade arriving on Friday alone. Now, let's just put this into a little bit of context, okay? For the weekdays between September 23rd through September 27th, a total of 273,417 containers were imported through customs at these ports with a value of approximately $13.67 billion. Walmart alone imported 47.7 thousand containers, IKEA at 42.9 thousand, Samsung at 33.8 thousand. You have Home Depot, Continental Tire, Hyundai, General Motors, Dollar General, Amazon, Folgers, Michelin, right? Pepsi, Heineken. Come on. Are we serious right now? I can't believe this is not a bigger concern on Wall Street. I think everyone is at this point, if you're big money, you're probably living in delusion land. Delulu land, as I like to call it. The only people that are not are the logical retail investors. And I'll tell you why that is. Wall Street does not get paid nearly as much if they scare you. Fear does not make money on Wall Street. Fear is the destroyer of money on Wall Street, because you know what people do when they're scared? If you're 60 years old, are you really going to sit through another recession and not be able to retire, potentially lose 50% of your money? A lot of people 60 years old have probably lost 50% of their money if they've been invested in markets since they were 25, at least 2 or 3 times by now, right? With over 50% decline in the dot-com bubble, 50% decline in 2008, even COVID, if you want to throw that in there, 30% decline or so. I mean, you do not make management fees by having people withdraw their money. That's the problem here. It's not that markets are accurately priced or that things are fantastic. It's quite the opposite. Things are not great. Things are not fantastic. Unfortunately, the Fed is obligated to lie to you to ensure their dual mandate, right? The last thing the Fed's going to do is spook markets, cause a recession. We know that's not how the Fed likes to operate, okay? That's not good for their business either. And it's not good for Wall Street, to be honest with you. And that, my friends, is the problem between people telling you how it is on YouTube, for an example, retail investors or people that, you know, just manage portfolios like myself. We can sit here and tell you the truth because we're not dependent on management fees, you know, to fund our lifestyle, right? And that's why a lot of people on YouTube right now in the finance community are not very bullish. But everyone on Wall Street seems to be very bullish. It's like laughable, okay? It's so obvious, it's stupid for anyone like myself that has been in the markets 5+ years. I've really almost been in the markets about 10 years, but some of these things just start to become more obvious if you've been in the markets 5 or more years. Now, I do want to go ahead and play this clip for you, the clip that I called out earlier in this video. It says the economy will see ripple effects of strike within hours, says U.S. Chamber of Commerce Bradley. Again, because I don't think this is a big deal if things just get resolved quickly. But judging off of the demands the labor union is making, things are not going to be resolved quickly. And the government's not going to step in and force union workers to work with no contract during an election year. It's not going to happen. Sure, they're going to put pressure on both sides, I'm sure. Okay, let's be honest there. But losing the union worker that majority swings Democratic is not exactly what you want to do 6 weeks before an election. I'm just going to put that out there because, again, I'm not paid by your management fees. And that's the truth. And I like to think honesty is indeed the best policy. That's why if now was a great time to invest, I would tell you to go all in because the Fed is cutting rates. Historically, though, it's actually the time to get out of markets when the Fed cuts rates, which I think is one of the most blatant kind of signs you can see of this delusion that Wall Street is in to tell you don't fight the Fed, be super long this market, you know, stocks are going to do another 20% next year, when in all actuality, that doesn't happen when the Fed cuts rates. You can look at 2019. Yeah, sure, we rallied after the first cut for a couple months, then you ended up falling 20+%. And that was only a 25 basis point cut. Before then, the Fed cut rates 2007, phew, off a cliff. Before then, the Fed cut rates in 1999, ooh, off a cliff, okay? 1995, the Fed cut rates. There was turbulence and volatility in markets. Nothing like we see in a straight line up until about 1997 when markets really started to take off from that point. You go back to the 80s, you go back to the 70s, right? Anytime the Fed is cutting rates historically is a time you want to de-risk portfolios, not add risk. And right now, markets are already priced for extremely low, probable outcomes. The probable outcome that the economy just accelerates from here and meets 25% EPS expectations next year with a rising unemployment rate is pretty damn low. Maybe a 3% chance. Is that enough to hang your hat on? I personally don't think so. And this video was actually prompted because I responded to a comment on one of the last videos where some individual, I'm not going to mention the name, basically said that it's funny how bad I want a recession. It's again quite the opposite. I just don't want to walk into a recession or walk into a 20% downside, month or quarter for markets when we all know damn well that's coming, right? I want as many people to be, ready for that so your family can benefit from that, rather than being blindsided because you're getting the delusional side of Wall Street. Even if everything goes off without a hitch in 2025, you're looking at about 4.5% upside. Judging off of 22 times earnings multiple, around $270 of EPS next year, $274 of EPS. I mean, that's not that good. Let me just be honest with you. The equity risk premium from that standpoint is terrible. If you can get almost 4% in a treasury bond. I mean, for a 1-year bond, you could get still about 4.5%. Why would you take any risk in equities for the next year?
of Commerce Chief Policy Officer Neil Bradley. The chamber out with a new poll about the potential strike, saying a majority of Americans want the government to step in and stop it, and just sent a letter to President Biden urging him to intervene. Neil, it's great to have you on. I've seen numbers as high from JP Morgan as $5 billion a day in economic impact. But we also know that a lot of the shipping companies, a lot of the shippers who have their goods on those ships that would normally be coming into East and Gulf Coast ports have been diverting them and making other plans. So at what point could this truly become harmful and detrimental to the economy and start impacting consumers and businesses?
Well, Morgan, thanks for having me on. If we have a strike at 12:01 tonight, which it does look like that's where we're heading, within hours, you will start to see some of the ripple effects. So if you have just a 1-day strike, for example, that creates a backlog within these affected ports that takes on average 6 days to clear. If this strike goes on for 2 days, you're talking about 2 weeks just to clear up the mess that's been created. So it's not hard to imagine a situation where even a strike that only lasted 1 week actually disrupts the economy well into November. And if you're a small business who's counting on goods coming in over the next 2 weeks, for example, for your holiday sales season, you may miss out on the entire season if this strike actually occurs.
Now, we just mentioned that you sent a letter to President Biden. I mean, he has the power as the president to potentially invoke the 1947 Taft-Hartley Act. That gives the federal government authority to step in labor disputes. But he's also been pretty vocal in saying he's not going to do that. So what is your message to him today, and why do you think you can change his mind if it does involve invoking that act?
Well, taking the invocation of Taft-Hartley off the table is just a mistake. This is not like it's a new idea. As you pointed out, it's been in the law since 1947. And on 37 different occasions, President Biden's predecessors have used this act to ensure that striking workers can't bring our economy to a complete halt. And so our message to the president is that this is much bigger than one union and these ports. This is really a question for our entire economy. He has the responsibility and the authority to use the powers under the law to protect our economy. And by the way, it happens to be what the American people want. We just released a poll today. 57% of Americans say the president should use this authority to protect our economy and keep the ports open and operating.
Neil, how many days do you think before this becomes a sort of red line event for the economy? How many days of striking?
Yeah, as I mentioned earlier, John, it really only takes 1 day of strike to have these type of ripple effects.
But how bad is that is what I'm asking. Sure, you have the ripple effects.
Sure.
You end up potentially with companies pursuing air freight instead, which costs a lot more, and I imagine those costs get passed along to the consumer, affecting inflation. But how many days, if you've calculated that, before it becomes a really serious problem?
Yeah, I think it's just a few days because, as you point out, this is a compounding effect. Look right now, look at spot shipping prices. Look at what's happened over the last few weeks as importers and exporters have tried to get ahead of this strike. They've actually driven up the cost of shipping goods into and out of the United States just by the threat of a strike. And so if we actually cross the threshold, if we actually end up in a strike, I think that is going to send shockwaves through the economy. Remember, we haven't had a strike on our East and Gulf Coast ports since 1977. That strike lasted for 44 days. It is a much bigger, much more trade-reliant economy today. If we even come close to that, you're talking about economic devastation for the United States.
I mean, we've seen labor take a much more aggressive approach and have the leverage to do it in recent years because it's been a tight labor market. And obviously, we've got Boeing and its striking machinists right now and reports that those talks have broken down as well. You've got the possibility that UAW workers at Stellantis factories are actually going to start going on strike as well for what they see as violations to their labor agreement. It all raises the question, is this labor's last stand if we do have a cooling job market, or does this unrest continue?
Yeah, I think we've entered a situation in which the demands that are being put forward by many labor leaders just are out of touch with kind of economic reality. Even in this situation, the port operators want to provide a big raise to workers, but the 77% raise that the union is demanding, there's just no way that the economics can accommodate that. By the way, all of us who buy things would end up paying that price. And so I think we have a situation today where you're right, the unions are feeling more emboldened, the union leadership, but their tactics have real collateral damage, from small businesses who can't get goods in to think about the restaurants around some of these factories that have been shuttered by recent strikes. There's no strike fund for the restaurant owner who loses all their business. There's no strike fund for the manufacturer who sells goods into these manufacturing plants. And so we're starting to see that this aggressive posture by labor leaders is really beginning to drag on our economy.
And that, my friends, is just how big of an event this could turn into. The problem is, I think he highlighted a great point. Today's economy is much more reliant on those ports, those imports and exports, compared to the 70s when it was, much less of a interconnected world, right? It was still interconnected, right? They were obviously important then, but today it's much different. We don't even understand with a decisive or predicted understanding of what this would actually do. Okay, we have estimates, but we don't know. We have no idea how much this could actually affect the economy. We know it will be big if they strike for even more than a couple of days, but we just don't know how big, how many businesses will be affected by these higher costs, how many businesses will not be able to get things, how many of these union workers will not have pay and affect their local economies. There's so many things that are interconnected. We just really don't know. And I find it crazy. Markets are in delusion land. And ultimately, it's your job as an active equity strategist, equity trader, investor, if you are active in this craft every day, to read through the bullshit, if you will, because that's what this is right now. But rant is over. Hopefully you guys understand how important this is. The official strike will be starting in just a couple of hours. So let me know what you guys think about this down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.